Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is a joy, and for Global Wall Street Lean Forward, Stuart Kaiser joins us now. He's got a fancy title, head of U.S. equity trading strategy at Citigroup. You've seen him in the TV show industry, and we've got him here for a long conversation today. What's the mood on institutional desks? Our review is retail's buying on the dip, and institutions are going mental over this, that, and the other thing. What's the mood that you see across pro desks?
I mean, I think people are a little bit concerned about the speed of the rally, but the fact is, it seems like systematic buying is really going to be very large over the next couple of weeks.
Catch up.
And people are not going to fight that. So I think even if you're a little negative the market as an institutional investor, you're sort of allowing this buying to play out, and then you'll kind of step back in, once that's done. So I would say, a little bit concerned with the speed, but, okay for now.
What we call long only buy side, which is basically conservative money. Folks are not doing hedge funds and all the fancy things you see on industry or billions. Forget about that. Long only buy side, do they feel behind right now?
I think a little bit, but the fact is the sell-off happened so quick and then the rally happened so quick back that, it was a little hard to capture the rally, but it was also a little hard to risk manage the way down. So I think they're actually just pretty happy. We've gotten the price levels back, back to where it was. If you look at,
So they were dumb going down and dumb going up. I love it.
Well, I prefer the word patient, patient and strategic. But yeah, I mean, to give you an example, we had a lot of investors coming in where you're on the lows. What are the 10 or 15 stocks you would buy here? By the time they would have put that trade on, we were already 10% higher. We kind of made a joke last weekend, that whole 17% rally, if you timed it perfect, you only needed to own the market for 60 minutes.
Oh, stop the show. Exactly. You work on the weekends?
Sometimes, yeah. Sometimes.
Is this just because Jane's in a commute right now and you need her to hear your work?
No. I have to catch up on all your YouTube work,
there we go.
And I can't do it during the week.
Sectors, sir, what are you guys seeing on your desk? Are people just are they jumping back into tech? Are they just trying to buy good balance sheets? What are they buying out there when they did come back?
Yeah, I mean, tech and growth, I think, have been the stocks that have driven the rally the most. Two things I would just highlight. Institutional investors, two themes that they liked earlier in the year that they got hurt on but now are re-engaging in would be power generation. So all that power that we need for AI, and M&A targets. Coming into the year, we had thought we were going to get this big M&A cycle. All the tariff news, all the market volatility, delayed that. I think people are hoping now that things stabilize that we will get a little bit of an M&A cycle, and that's going to be good for the bank sector. So I think those are two areas, growth and banks, that people are focused on. Healthcare has been real tricky, so I think people are kind of staying away from that. A big OPEC meeting, today I think it is, so you'll have some focus on energy. But I think to the long side, it's been growth stocks, particularly tech, and then some re-entry into the bank space.
We had Gina Martin Adams on earlier. She's a U.S. equity strategist for Bloomberg Intelligence, and she was saying this non-U.S. trade into Europe and other non-U.S. markets, that's still there. It's still playing. Are you still having those conversations with your clients that they want to own maybe some European stocks?
We're still having the conversations. I think the fact that, we've backed off the worst of the tariff outcomes has made people a little more comfortable kind of being in the U.S. But yeah, I mean, the Europe versus U.S. trade, particularly when you got that fiscal announcement. Yeah, I think the view is it was a very high bar to get the Europeans to spend money. The fact that they were committing to do that gets real money in the U.S. a little more comfortable owning Europe. And I think it's given it another leg there. The fact is, though, you've not seen an extended period of Europe beating the U.S. probably for about 20 years. So there is, I think people like the trade, but they respect that and are a little bit, cautious about how long it might keep going.
They got to relearn the stock symbols. Stuart Kaiser with us on your commute across the nation. Good morning. Particularly good morning on Android Auto. Google, did you see they did their little roadshow thing yesterday?
Yeah, yesterday. It was big.
AI is big. It was bigger than I thought. Ed
Ludlow was out there reporting.
I got to actually read about it, to get up to speed. Gemini. Yes, Gemini and all that. Anyways, good morning on your commute. Good morning on YouTube as well. Thank you. YouTube, when we put this together, there's a huge deal. Should we have makeup or not makeup?
No,
it was like a major debate, folks. Mateo had a tantrum, or people came in.
You have to invest
and
in your
they
face.
said, look, I'm endorsed by Bobby Brown and Mac.
Yep.
I got to have the makeup going. So Lisa's the only one that beautifies here. And so to have Steve Roach on the phone looking over, and Steve, the camera's over there.
Yep.
But that's the way we roll on YouTube. Stuart Kaiser without makeup this morning. I want you to talk about Mag 7 in position sizing. What do your big clients, what do they do when they go, I think we need more Apple? Just as one example, how do you affect position sizing in Mag 7?
Look, at Tom, it's a great question, because at the beginning of the year, the two biggest challenges to the Mag 7 trade were valuation and positioning. From mid-February till March, those two things got addressed pretty quickly. Valuation down 25%, positioning kind of pulled off. I think what we've seen, frankly, is a lot of people in that AI trade kind of sizing up a little more on the software side, a little less on the
Microsoft on a tear.
Yeah, Microsoft Meta, has obviously been a favorite. In terms of sizing the other stuff, honestly, the flows we've seen recently have been almost across the board. Like, I'm going to trade Mag 7. Maybe I pull Tesla out because Tesla's had a little bit of political risk, but I'm going to pretty much put a $1 or $10 million in each of those stocks on generally
so
an equal basis.
So an odd lot for you is $10 million.
For me personally, no. An odd lot for me is about $50.
But at Citigroup, an odd lot is $10 million. Give it to the intern to trade.
Yeah, I mean, look, these stocks are. I mean, you're talking $3 trillion in market cap for some of these stocks. So the notional sizes going through are quite large. I think you're generally approximately equal weight, but going into each quarter, there's always one or two that are favorites that are a little more widely held, and a couple that are less liked. And again, I think the software side of that ledger is a little more over-owned right now, and perhaps the tech hardware and semis a little less owned at the moment.
What's going to drive this market for the remainder of the year? I'm looking at the WIRP function, and I think I've only got a couple of Fed cuts maybe in the forecast. Is it earnings? Is it just what comes out of Washington, D.C., and what comes over X or Twitter, whatever it's called? Is that what drives the market today?
Look, I think near term, like the next month or so, it's a lot about positioning. And now that you had that Moody's downgrade, it's going to be what happens in the long end of the bond curve, as you guys were chatting about earlier. Medium term, let's call that July through September, it's going to really all be, to me, about EPS and GDP growth.
Okay.
Both the Fed and corporate America took a wait and see approach in the first quarter. I don't think that's going to be sustainable through the summer. So we're ultimately either going to see relief and the recession risks get priced out, or we're going to see EPS and GDP numbers come down, and that's going to be kind of a waiting on the market. So I think, frankly, let's call it July through September, through the September Fed. This is really going to be about the growth outlook.
It seems like, earnings growth, I don't know what Scott Croner's saying, but we've got earnings growth was like 13, 14, 15% for this year. Now it's down to like 7. Is there still risk in earnings growth, do you think?
I think there is still risk. Scott was at 270 for the year.
Okay.
He took his number down to 255.
Wow.
That number does not include a recession. So the downside risk from here is less tariffs, because I think we've trimmed the tail risk off tariffs, and it's more about what is happening to the economy. So I do think there is a bit more downside to earnings, but it's going to be relying on economic data. I think most people at this point have incorporated some degree of tariff headwind.
Yep.
So do institutions call you up? It's like industry when they got to go to break and get to the next season. Do people call up and say, go to cash at that size and scale? People don't do that, right?
Look, it depends. Like a mutual fund long only can't really be in cash, right? Regulatory-wise, they can't be. Hedge funds, yes. Hedge funds will go
They'll
cash.
call up and say, clear out these 4 positions.
Yeah.
Then how do you do that?
We push a button these days, I think. No, man, I think what's interesting, and Tom, you're raising an interesting point, is the selling that we saw earlier in the year was much more what we call low touch, going through the pipes, going through the computers, going through the algorithms. We haven't had those days where they are calling up our high touch sales desk and just saying, get me out quick. And I think part of the reason for that is something you touched on earlier. People are so long these stocks that if you're trimming up your positions, you need to do it quite quietly, if that makes sense.
I'm not going to mention the name here. The name doesn't matter. Folks, in the Bloomberg, you can't believe the information you've got when you get the terminal. Get the terminal, folks. You need it in your car. So I got a very famous regional American name. They own 7.163679 Microsoft shares. So when they call up and say sell a 10% position, 717,000 shares, How do you actually do that? Do you just put in a sell order for 700? You don't do that, right?
No, I mean, like a lot of that is done, gradually throughout the day. On a evaluated price. Unless it is we have to get out. And look, what I would say too is the retail participation in the market is much larger today than it was a few years ago. So actually, if you're an institutional investor selling stock,
to retail.
You're selling to a levered ETF. You're selling to retail demand. Again, you're not just dumping it in one block. You're taking your time. You're spreading it out over the day, and you're making it work.
Jane calls in. Jane, thank you so much for calling in from Connecticut. If you sell 4% of that 717,000 and you have to wait 20 minutes, what do you do in the meantime?
Get coffee.
You get coffee. That's what I thought.
That's how it works.
And if it's there 4 o'clock, it's like, where are we going to have a beverage?
Exactly. So during that sell-off we saw earlier, Stuart, earlier in the year, we had some really, maybe a 5 or 6 day period where it wasn't panic selling. Everybody said it was kind of orderly selling. What were the calls you're getting from your clients? Was it the get me out call, or was it, hey, we're taking some risk off the table kind of call?
I think it was more the latter. As you said, it wasn't a discombobulated and aggressive sell-off. I think people were pretty measured about it. As I mentioned, a lot of that was going through the computers, going through the algos, less, just calling us up and saying, sort of, get me out now. Obviously, there was some of that. Yep. But no, it was a pretty orderly sell-off. But if you think of the sell-off, it happened in 2 stages, right? You had about a 10% drawdown in late February, and then you had another, post the tariff announcement. The first of those 10% pullbacks was a little bit more disorderly, a little bit more stressed. Once you got that initial pullback, a lot of institutional investors got their risk right-sized. And when you had that second pullback, I think people were much more prepared for it, if it makes sense.
This is brilliant. I did not observe, and folks, I'm making it up. I by no means have my thumb on the market, not that I ever did. But I didn't see catharsis there. In the like Bitcoin, I don't follow, folks, because the drift of Bitcoin is a fiction. But in your world, Stuart Kaiser, I didn't see panic. I didn't see catharsis.
Look, I think, and Tom, to your point, I mean, you basically, Liberation Day was April 2nd. The market bottomed on April 7th intraday, and on April 8th on a close to close. It was really a 3 to 5 day sell-off. It didn't feel like that, but that's what the price action would tell you. So look, you had a few moments there where you got the VIX up to 50, 60, and I think that was the closest we got to kind of, complete fear-based selling. The fact is, a good proxy for today, I think, is actually 2011. In the sense that it was sort of a self-created sell-off driven by government policy. And, the second the administration started to show that they were willing to negotiate and trim the tail risk off, I think people got much more comfortable that this isn't great risk reward, but this is not, a COVID or financial crisis.
Quickly, or season 4, Harry Laudie's not going to be back for industry. Are you going to be back for industry for season 4?
It's really up to the agents, Tom. We have to.
CAA, I understand. Stuart Kaiser on the street. I can't say enough, folks, the joy of Stuart. He's not coming in going, well, the Fed will do this. It's like real talk.
And I read Stuart's note every day because if I only have time for one paragraph, I got it. I can sound smart. Just with one paragraph, what's buying, what's selling, I got it.
Treasure from Citigroup, Stuart Kaiser, thank you so much. Jane, be nice to him. I'm sorry.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us now for an extended, important conversation here on your conviction to be in the equity markets, Brian Belski, Chief Investment Strategist for BMO Capital Markets. I'm sorry, Brian, for me, always and forever, the Bank of Montreal.
Oh my gosh,
Brian! Brian, I want you to talk about what I've lived, and a lot of younger people have never lived it. If price goes down and yields go up, stocks can still do well. Discuss that.
They can do very well, and thanks for mentioning Nick Roccanova too. First of all, one of the best names in Wall Street history. Number one. Number two, the poor man has worked with me for 18 years, so we should all pray
painful.
for him. I'm coming live to you, by the way, from the wonderful Jennifer Lee's office here at BMO headquarters in Toronto. So I feel like I'm in the midst of greatness.
In the glow.
Yeah, exactly. So I really think we wrote this piece and talk about voluminous piece. Nick lets me go crazy on the year ahead piece. We wrote this piece in 2022 for the 2023 year ahead, and we talked, Tom, about normalization in markets, something we talked about last appearance as well. And, stocks can go up when yields go up. The average 10-year treasury the last 75 years is 5%. 0% is not normal. What's happened in the Fed since August of 2007 is not normal. And I think we're kind of returning to normalcy. On the bond side of things, even though we're primarily equity people, we believe the majority of returns, total returns of bonds the next 10 years is going to be about yield, not price performance. Remember, the last 40 years, we've seen massive outperformance of bonds for the most part, and we've had great price performance. So I think, Tom, that we're entering into this period where more even returns for stocks, high single digit, low double digit, same thing with earnings growth, where a yield environment that can kind of hover in this 350 to 450 range predominantly.
So, even though you maintain, and rightfully so, Brian, your bullish stance here, I mean, it's been an amazing rebound in this market here. Still, your EPS for the S&P 500 still around $250. Does that support higher stocks from here?
It does. And we're in the bottom of the report, Paul, we talked about how we're not revising back to our 6,700 target, which was officially our initial target for 2025. It still remains our bull case at 275 for earnings and 6,700 for the price. However, as we wrote in the piece, we need to see some signposts, quite frankly. And one of them, to be clear, is we need to see guidance come back and we need to see earnings growth solidify. And so we think we're going to probably see that. So with the market, we're transitioning to show me from scare me. And I think the next quarter or two, which is a long time in Wall Street, brothers, a long time, the next quarter or two, I think we need to see earnings growth come in, and then we'll feel better about returning to our bull case at 6,700.
To get to a 6,700 target, does tech have to be a leadership category, Brian?
That's a great question. Yes and no. We don't think Meg 7 needs to be leadership. Meg 7 is all about liquidity. Tom and I talk about the 90s, and these stocks are the new consumer staple stocks, as we talked about, these big cap, these mega cap tech stocks. We're technically underweight the Meg 7 because we own zero Meta in our $11 billion that we run for BMO. But I think it's going to come from other areas of tech, whether or not it's bottom fishing in AMD or the great fundamental story of Palantir, or buying the dip in Palo Alto today, which the major theme of AI, we think, going forward is cybersecurity. It's maybe moving down in cap to a cyber arc with respect to cybersecurity. And even Oracle. Oracle's not in the Meg 7, but we're talking about a multi-billion-dollar company with a fantastic balance sheet and a great software company. So I think it's going to be other areas in tech, Paul, that outperform. And that's why we continue to be overweight, with respect to the technology sector.
So, Brian, it seems like, again, the volatility that we've seen here in, the first 5 months or so of the year has really come out of Washington, D.C. with economic policy, trade policy, just kind of bringing in a level of uncertainty into the markets. I'm not sure that's going to necessarily change going forward. How do you kind of come to grips with what is still going to be a higher tariff environment out there?
Right. That's one of the points that we make in terms of our signposts. Markets have to stop reacting to every little thing out of Washington, whether or not it's good, bad, or indifferent. And once we kind of get back to quote unquote business and normalcy, I think we'll feel better about the bull market, which remember, we're still in big, giant secular 25-year bull market. But again, given this uncertainty, I think too many people are trying to make the big call and go right back up to 7,000 on the market. The market needs some work to do. It doesn't mean we're not bullish. It just means we need to see some fundamental work.
Brian Belski on the X-axis where I live, folks. He's with BMO Capital Markets.
Hey, Brian, I'm looking at what we haven't talked about a lot really this year with all the talk on tariffs. We haven't talked about the Federal Reserve and interest rate policy here. Do we need the Fed to be accommodative here for this market to work?
I don't think so. And I think that's really the secret sauce there, Paul. I mean, I think at the end of the day, the end of quantitative tightening, Rates are still low relative to history. The Fed has a dual mandate. Employment remains very strong. Remember, employment is the laggingest of all indicators. It always happens last. And then on the inflation side, as you're talking about CPI, we'll see how PCE and all that kind of comes in going forward. But I think the Fed is done. I'm one that says the Fed's actually done a pretty good job. And so I don't think that we don't need an interest rate cut for the markets to go up.
What do we need in terms of, I don't know, just from the companies themselves? How do we need for these companies to step up and say we have better visibility, more visibility, any visibility on our earnings? Because the first quarter was kind of characterized as a lot of companies, rightfully so, just saying we don't know what's going on out there.
Right. And that's part of our signpost that we need to see guidance and earnings kind of growth numbers come back, meaning the show me side of things, Paul. And I do think, obviously, first quarter, the majority of earnings didn't have tariff-related type of issues. But at the end of the day, we want to see companies that have strong operating results, that operate from a bottoms-up basis very strongly, and have some guidance that say, hey, you know what, tariffs, smariffs, we're still going to have very strong and steady earnings. And oh, by the way, you know what you get, what you pay for, and you know what you're paying for in U.S. stocks. And so I think that's going to be the theme for the second half of the year.
Brian, have we ever seen retail and institutions so far apart? I mean, I got retail buying the dip. That's all there is to it. Belski's going to these Florida, Caribbean island stock conventions. People are day trading off their laptops while Belski's giving them pro tips. Okay, retail's all in, Brian. Institutions aren't. Has it ever been this nuts?
Great question. It's been on the other side. I would say, I remember having very complex and aggressive conversations with private wealth in March, April of 2020. Institutions were still late in getting out, Tom. And I think also too, I go back also to October of 2000, where retail was the opposite side. Retail was all in, completely all in. And you started to see the technology crack a little bit. In the U.S., foreign investors were still very, very aggressive. I, quite frankly, hate the notion of retail's dumb money and institutional's smart money. It's actually the opposite. It's actually the opposite. And I think that's part and parcel, Tom, quite frankly, to what happened in the late 90s, because retail, private wealth really learned their lesson to be too overexposed in stocks, and wealth managers done a wonderful job kind of diversifying. So I think it's the dumb money is actually the hedge funds and the short-term money that's trying to chase these momentum moves. And oh, by the way, they've been wrong.
Is that because they have access to leverage? I mean, there was a white paper years ago, sorry, folks, I can't cite it, that if you get out over 2.8 to 1 or 3 to 1 leverage, things fall apart. I mean, it's just about institutions are leveraged up, and that's where they get into trouble.
I think it's part leverage, quite frankly, but it also, I think, too, is that institutions, they own too many stocks in these big portfolios, and they haven't made the right bets. And I think that they're chasing momentum, quite frankly, and there's not a lot of independent thought. When I go in and talk to a big institution, Tom and Paul, and I start talking about stock picking, it's like their eyes gloss over, because for the most part, they're just kind of chasing the momentum. They don't really want to talk about operating performance and management and product and service. So I think that's kind of the rule we're in. And oh, by the way, retail, i.e. private wealth, they love stories. They want to talk stories about stocks, and institutions have kind of forgotten how to take stories.
Really, that's really, really interesting. I'll have to have you back for that. I got one final question. Knicks or Pacers?
Knicks, come on. The Wolves choked last night. I want to see the Cat taking on their old team, the Wolves, so we got to get going.
Brian Belski, thank you so much. BMO Capital Markets. Thank you, Nicholas Roccanova, for writing everything Belski does.
Of course.
He's riding around in a Rolls Royce.
That's how it works.
He's like, Nick, let's do something on this. Okay, great. We'll do that. Brian Belski, thank you so much. We'll get him back here. That's a really important discussion, Paul, about retail institutional.
Yep.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A quick visit right now. He is at Yale Law School. He invented Morgan Stanley Economics. Stephen Roach joins us with his decades of study of China. Stephen, I was reading Ken Rogoff last night, my book of the summer, Our Dollar, Your Problem. And there's one page in the last chapter on China where he makes clear everything changed with President Xi. The totalitarian sense of it, the inward sense of it. It's the president and his buddies. Do we understand that in our negotiations with China, the unique character of this regime in Beijing?
First of all, Tom, thank you for talking to me. Your intro makes me sound a little bit like Thomas Edison. But with respect to Ken's point, I would respectfully disagree. China's been on a trajectory that has been pointing in this direction really since the late 70s and post-Mao, Deng Xiaoping China. Under Xi Jinping, things have certainly crystallized much more around an authoritarian, single leader-dominated system. But the trend of economic policy, state-directed industrial policy, repressed consumption, an unbalanced Chinese economy, increasingly at odds with the rest of the world, that has been evident for a long time prior to the ascendancy of Xi Jinping.
So, Stephen, I mean, there was a period there where China was really embracing the West and vice versa, and there was a lot of optimism for mutual growth. Are the people of China, are they comfortable with where they are now and where President Xi is taking this economy?
Look, I've written books about U.S.-China codependency, the relationship that was initially constructive from perspective of both countries relying on each other. And I think the people of China that I speak to, and I still go there on a regular basis, would love nothing better than to go back to that comfortable codependency. But the leaders, the political leaders of both nations, and in the case of the U.S., I wouldn't just single out the president, but most importantly, I'd emphasize the U.S. Congress, don't see it that way anymore, and the Chinese people don't fully understand what has changed to alter that balance.
Stephen Roach with us with Yale Law School. We will continue here. Futures -33, Dow futures at -330, and the VIX 18.58. Dr. Roach, I think that within your travels, and you're in China often, what have you observed? What's changed? What has changed in the modern China versus the years ago getting off the airplane and seeing that giant Morgan Stanley sign at Hong Kong's airport?
Well, first of all, the sign is gone, Tom, and
so is the chief economist.
Yeah, that happened after I left Asia and came back. It would still be there if I was still in Hong Kong. But look, what's changed a lot is China's rise as a superpower driven largely by extraordinary progress in technology and what Xi Jinping calls, new high-quality productive forces. What has not changed is that China's been unable to stimulate internal private consumption.
Why not? Let's stop there. That's important. This has been for years, Stephen. You wrote about this with Richard Berner years ago. Why can't they stimulate consumption?
Well, the main reason, in my view, Tom, is they just don't have a robust social safety net, healthcare and pensions. And what that means is that, Chinese people, when they earn money from working, they save it because of a fear of an uncertain future. And that fear-driven precautionary saving means that an incremental renminbi of income goes into savings. They've got a personal savings rate that's, over 30%, the highest in the world.
So, Stephen, what is your view of the 1 to 3 year economic outlook for China? Because that will have an impact on the global economy.
Well, I think the outlook is worrisome. China, because of this sort of stymied rebalancing, is still heavily dependent on exports. Exports are about 20% of their GDP. Their largest trading partner remains the United States, even though the U.S. share has fallen significantly since the first round of Trump tariffs. So they're going to get hit by this external demand shock emanating from the U.S., exacerbated by Trump's tariffs, and the risks are on the downside.
Steve Roach, don't be a stranger. Too short a visit. We greatly appreciate it. With Yale University, where he gives out C's. That's all. He's tough.
Solid.
Getting a B
take
from
C
Dr. Roach.
Stephen Roach.
It's very hard to do.
No problem at all.
Stephen Roach, thank you. Can't say enough about some of his efforts in writing on China. I'll get those out on LinkedIn and Twitter here as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Mohamed El-Erian, the zeitgeist was out there, but El-Erian nails it with a tweet that this has been underreported this morning in the United States. United Kingdom service sector inflation up. They were looking for 3.3%, and their UK inflation statistic came in at a lofty 3.5% in April. That bears close watching, and that goes over to Paul Sweeney's 30-year bond, which is, my eyes are failing me right now. There it is, 5.02%.
Yeah, that gets your attention.
Joining us right now, and, I got to be honest, folks, I got the 201k. And the 201k is with Empower, and I could go in and when I log in, they got a blinking red light.
Yep.
Stupid. Put in more money.
Exactly.
Thank you, Empower, for that. Empower keeping track of all the retirement plans for all of us at Bloomberg LP, and we say thank you. They went out and got Marta Norton to be their investment strategist. What's it like being an investment strategist where we don't care what you think May's going to be like? We're looking at a 3-year, a 5-year, a 10-year perspective. How do you write along the Empower line?
Well, I think what's really valuable to the retirement market, to I would say individual investors broadly, is making sure that the focus is on the fundamentals. I think there's so much noise out there from kind of data point to data point, headline to headline,
right,
and it can really have an emotional toll on people. And so my orientation with Empower, whether it's the wealth side of the business, whether it's the retirement business, is to understand and, aim to understand what's happening with the fundamentals and how should that drive their views.
But your charm is you were at Morningstar, and you lived the certitude of a 5-star fund that all of a sudden stumbled and became a 3-star fund. How do you get long-term investment in a select group of funds correct?
Okay, so that's a great question. And of course, I think if you're looking at the data, a big part of it is the expenses equation. If you're trying to think through kind of what's going to drive performance over time.
She read Balchunas' book? Is that what this is about?
You do want to keep those costs down, right? That's your one certainty in terms of what you're paying. You want to keep that as low as you can. But I also think my kind of grounding at Morningstar, one of the biggest takeaways that I had, and to your point, I grew up as an investor at Morningstar. It was the importance of an investment philosophy, having a point of view, a framework that would help you distill what's happening in the markets and make determinations going forward. If you look at, kind of the most successful strategies out there, they're not successful in every environment, but they have a touchstone that they return to. And I think those touchstones are really important to navigating choppy markets.
So what is your investment outlook, your strategy for 2025? Where we've had a lot of volatility here, a big, about a 20% drawdown in the market. We retraced a lot of that here, but it's kind of driven by not so much the fundamentals of company A or company B, but kind of trade policy out of Washington, D.C., economic uncertainty. So how do you guys talk to your clients about this?
Well, it's funny because back, pre-election, a lot of the commentary I was putting out was that, your portfolio is not dependent on who's in Washington or what's in control or kind of how you feel politically about things. And yet we head into 2025 and it's been the year of fiscal policy. Yeah. And it's been decisions out of Washington that have caused kind of the ups and downs of the market. We entered 2025 talking a lot about valuation and really concerned about the economy, in our estimation, seemed reasonably healthy, but the valuations seemed high, especially in the Mag 7. And so that was our greatest risk factor. And it seems like we've lived 9 lives since the start of 2025.
We all have, yeah.
Right? And so the valuation picture changed and then changed again. And I guess if I think back to that outlook at 2025 and where we stand today, one of the biggest changes has been where the Mag 7 is. The broad market looks expensive like it did back then, but the Mag 7 looked cheap. And that was a surprise to me because my expectation was that Mag 7 dictated the market.
Is with all your work, are we over diversified in our 401ks? Peter Lynch was really good on this at Fidelity. Are there just too many things in our 401ks?
Well, I mean, that depends on kind of how you're, if you're picking your own strategies, if you're picking your own investments within your 401k, then, it all depends on kind of those individual selections. 3 or 4 things. Paul can pick them. He's smarter than me. And the answer is we got advisors out there that are saying you need 42 things in your 401k. It causes angst and empower. People get old and empower over this. There is there's kind of like a retail market that follows the endowment market, the endowment-like approach where you had to have a very diversified, a healthy selection of all these various investments. But I would say the average, retail investor it's still a 60-40 split, stock bonds. It's still kind of a vanilla approach to the market. So I wouldn't say that, my impression of the average 401k investor is that they're too diversified, though I think there is that, argument that people are trying to put a lot of stuff in portfolios.
How about fixed income here? I mean, again, Tom and I talk about the 2-year treasury at 4%. That's not a bad way to make a living, or do we take some credit risk here?
So I think it's kind of an interesting market. One of the things that we've called for 2025 is a year for coupon clipping. That idea of capital appreciation coming from your fixed income. It's just harder to get behind that when you think of the inflation forces or the deficit forces or everything that kind of is putting a floor potentially under the yield curve. Now that felt like that was potentially the wrong view earlier in the year, but we're back to that situation, right? Where people are focused on the deficit and they're thinking about yields in kind of a range bound mindset rather than, necessarily falling from here. I think one thing that's really important, and this has been a shift, has been thinking about as you're looking for capital preservation as an individual investor, not just going to the ag or the core bond space, but thinking about that breadth of the yield curve and having some of the shorter dated securities in your portfolio. They have a very different risk profile. The inflation risk is not the same. The rate risk is not the same. They showed that in 2022 and they've shown it since. And so I think that breadth is a really important element for construction.
How do you guys think about alternatives? I mean, it's become such a big part of the average RIA that we go talk to. It's not 5% of the allocation. It's a lot bigger.
It's a lot bigger.
And I'm surprised by that, whether it's private equity, private debt, hedge funds. How do you guys think about that?
Yeah, so Empower is moving into or partnering with alts in the private equity sense. But I guess when I think about your question, I want to expand on it a little bit because I think the word alternative is such a catch-all. And it's important to define what we mean by alternative. So if we're thinking about something like private equity, I think the real case for private equity, of course, is the breadth, the broader exposure to the U.S. equity market. But I think the operative word is equity. This is equity-like exposure. And so you have to size it accordingly. You have public equity in your portfolio. So you have to think about that as you're looking at private equity.
Are you in Chicago or are you in Winnipeg?
Chicago.
You're deep south. Okay. With Empower, thank you so much. Marta Norton, greatly appreciated. Chief Investment Strategist for Empower.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Right now, with the newspapers, who else but Lisa Matei?
All right, this is from the Wall Street Journal. This is a really interesting look at the real estate market in New York City. It looks like downtown is actually the new uptown for the rich and the wealthy. That's where they're going now. The city, right? The most expensive real estate has traditionally been like Billionaires Row, Central Park West, Upper East Side. But now things are changing. Listings below 14th Street are actually starting to compete with it.
Nice.
A lot of things. Firms, a lot of tech firms, finance firms are moving down there. more retail, parks moving down there, new luxury condo developments along the West Side Highway. You've seen them, West Village, Tribeca, Chelsea. And that's the reason why. They did say there were more $30 million plus home sales below 34th Street in the past 5 years than in the previous decade.
I did read that article in the journal, and some of the places they had there were spectacular.
Spectacular,
Oh, my
like
goodness.
85 million, like,
Yes.
like big
You know, I was
bucks.
just but I was on the Upper West Side last night walking around. That is a great place to live. I always felt comfortable up there. It's nice. I lived on the Upper East back in the day, but Upper West, I don't know, the city's a great place to be. Period.
Damien Cesar sent me this morning, thank you, Natalie Wong, the IBM building, which is a lovely black granite building at Madison in 56-ish, sold 1.1 billion, new top tick.
Oh,
Just in the last 24 hours.
Nice. Very good.
RXR's taken it out.
Yep.
There's a spirit here to it within the lumpiness. I actually saw a restaurant yesterday doing the curb thing, setting up the tables
Oh, yes,
for
the
the
patio,
outside.
the outdoor dining.
Next, what do you got?
That is the season. Football could have its own version of the U.S. Olympic Dream Team. Not traditional football, we're talking flag football, okay? But the NFL team owners, what they did is they approved this resolution. It could allow those pro players to participate in flag football at the 2028 Olympics in Los Angeles.
Okay.
So it's really, you've seen the NFL,
But do
they've
they
been
play
pushing
flag
to make
football
it.
around the world?
They do, but not in the Olympics.
Yeah,
So
but I'm like,
they haven't laid
did they play flag football in Japan or Italy? I don't know.
Well, now we'll find
out.
in 2028 at the Olympics. But they're just trying to get, the NFL's been pushing to get them on this global stage. So this is really a
That's
good
a good
way
point.
for them. But I mean, there's still more talks that have to be done, right? You have to talk about injuries, thing to consider. So they have to negotiate all this.
But
What if
one
someone
player
gets hurt?
per team is what I understand. That's like kind of the max.
One player per team. Okay.
Yeah, okay.
And a couple players have expressed
When
interest.
is the
Patrick
Olympics?
Mahomes
When is
says
the
he'll do it.
When is the LA Olympics?
2028. So we have a
So
few
it's a
more
couple years.
It's a
That's
couple
gonna be
years.
huge.
Between the fire
Yeah.
and just LA and the sprawl, the Good Morning Los Angeles in your early morning, they got time to make it happen.
Yes.
They're not
And they've got most of the venues, most of the infrastructure there already. That's why you like going to LA and Salt Lake, for example.
You got one more this morning?
I do. Okay, so there's an item from Lululemon. It is all the
I'm a
talk on
huge fan.
social
Why am I
media.
Huge
do
fan.
this?
Okay, it has nothing to do with working out either, or leggings.
yes.
Okay, so it is their 2-in-1 maxi dress. So 2-in-1 because it can be used as a strapless
Such a girl
dress
thing.
and a long skirt. Miss Keene would love this. It's $148. 4 colors she can choose from. It's great. But the thing is that it's getting kind of backlash too, because people are saying $148 for, a long dress, a little expensive. But it's Lululemon. You have to think about that too. And they love the versatility, how soft it is.
It can be worn as a
It's
skirt when its
yes.
top is folded over
How
the
did
hips.
this get
Yes.
through the editors? I mean, how did this story get through the gauntlet of surveillance editors?
It's on my
Tsai,
Christmas
help me
list
here.
now.
There you go.
On the Mateo Christmas
Anything else
list.
you'd like to? Is there a bag that is happening for you right now?
Oh, you know what? No, actually no. This will be it. This will be my thing for the summer.
Lululemon.
This is what you wear on the beach, around the streets of New York City. It's the mini maxi dress.
And we'll do the newspapers tomorrow, I think. Lisa Mateo, thank you so much. Greatly appreciated.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.